In late December, silver did something that should make any serious market watcher sit up straight. The quoted futures price slid hard, almost as if supply had suddenly appeared out of nowhere, while the physical market in key hubs was printing numbers that belonged in a different universe. In Dubai, deals were being talked about around $91 an ounce. In Shanghai, $85. Yet the reference price most screens show was closer to the mid-70s. That's not a normal spread, that's a fracture line. And it didn't take months, not weeks. They said a gap like that couldn't persist in a modern liquid market. They said arbitrage would erase it. They said the system was built to prevent exactly this kind of divergence. But the market doesn't care what anyone says. It cares about constraints. Here's the part most people miss. The moment you see a split between paper pricing and real-world acquisition, you're no longer watching a simple commodity trade. You are watching a stress test of a financial plumbing system. And in stress tests, institutions don't wait for confirmation. They position first, then they explain later. By the time the average viewer sees a headline, the inventory has already moved, the rules have already changed, and the leverage has already been repriced. What I'm about to lay out isn't hype, and it isn't a conspiracy story. It's a pattern. It's dates, numbers, and mechanisms. And once you see how the mechanism works, you stop asking why silver should do something, and you start asking who is forced to do something. Welcome to the data ledger, where we decode what matters before it becomes a talking point. If you've been around here, you know the routine. We don't chase noise, we read the signals. Subscribe the way you'd keep an old, wise voice nearby, because the calm explanations are usually the ones you need when markets get loud. And tell me where you're watching from, because these shortages don't hit every region the same way. Now, let's reconstruct what actually happened. On December 29th, 2025, the cost of holding silver exposure changed overnight. The CME raised margin requirements for March 2026 silver contracts from $22,000 to roughly $25,000 per contract. That is not a minor tweak. That is a sudden increase in the cash you must post just to stay in the position. When margin rises, it does one thing reliably. It forces the weakest hands to sell. If you're running a leveraged book, you don't get to debate the long-term thesis in that moment. You get a message from risk management. Add cash or reduce exposure. If you're a fund with multiple positions, you sell what you can sell, not what you want to sell. And silver futures, because they are liquid, become the release valve. The demand hasn't vanished. The rules around leverage have shifted. And here's the abnormality. While paper selling accelerates, physical premiums don't collapse. They widen. Because the buyers in the physical market are not playing the same game. They are not rolling contracts and posting margin. They are trying to source metal that has to show up, be assayed, be shipped, be held, and be used. So you get two different truths at the same time. Screens show pressure. Physical channels show strain. That's the central mystery, and it's exactly where hidden crises tend to live, in the gap between a financial representation and a real-world constraint. To understand why this matters, you have to step back and look at the historical playbook. Silver has a long history of being managed by mechanics rather than by narrative. When it moves, the first response is often not a story about mining. It's a story about margins, position limits, and forced liquidation. In 1980, silver became the stage for one of the most famous commodity dramas ever recorded. Prices surged, the system tightened, and the rules changed as volatility exploded. The details differ depending on who tells the story, but the core pattern is consistent. When a market threatens to deliver more stress than the system can handle, the system reaches for levers. Those levers don't care about fairness. They care about stability. Fast forward to 2011. Silver ran hard into the spring. Enthusiasm was everywhere. And then the rug felt like it moved. Margins rose in rapid succession. The cost of staying in a position jumped again and again, and the price collapsed with a speed that left casual participants stunned. The lesson was that a leveraged market can be made to liquidate faster than a physical market can respond. Now look at the present. In 2024, global silver fundamentals were already tight. According to industry survey data, the market ran a deficit of 148.9 million ounces that year. Industrial demand hit 680.5 million ounces, a record, and it wasn't a one-off. It was the fourth record year in a row. That's not sentiment, that's consumption. When industrial demand sets records, it doesn't behave like speculative demand. A solar manufacturer can't replace silver with a tweet. An electronic supply chain can't wait for a dip if orders have deadlines. Once demand is embedded in production, it becomes inelastic in the short run. Price can influence it over time, but not instantly. That is why a paper-driven sell-off can happen alongside physical tightness. The physical buyers are still there. They're just not quoting their bids in a futures pit. So if the deficit is real and industrial pull is rising, why does the market sometimes look calm? Because visible inventories can create a false sense of comfort. London vaults, for example, show large tonnage numbers. They look reassuring at first glance. But a vault total is not the same thing as immediately available supply. Some metal is pledged, some is earmarked, some is sitting under ownership structures that won't release it at the posted price. A total number can be huge, while the float, the portion that can actually move without breaking, someone else's structure, is much smaller. This is where institutional behavior becomes the main story. They watch custody data, inventory categories, leasing conditions, and the cost of financing. They watch the points where paper contracts are supposed to convert into delivery, and they watch what happens when too many people ask for the same exit. They also watch rule changes, because rule changes are where the game is truly played. A margin hike is not merely a response to volatility, it is a volatility amplifier. Raise the cost of participation, and you shake out the marginal players. Lower the cost, and you invite more leverage. When you see a series of tightening moves, you are watching the system try to reduce risk by reducing positions, regardless of the underlying reality. At the same time, you see behavior that looks like quiet accumulation through structures that can absorb metal. Exchange-traded products, custody programs, and private vaulting channels become magnets. Holdings figures become a clue, not because they are perfect, but because they show where demand is trying to live. When reported holdings rise, someone is choosing to park metal in a vehicle rather than leave exposure purely in derivatives. And then comes the dislocation, the moment where two markets tell opposite stories. On one side, you have the reference futures price driven by leverage, roll dynamics, and forced flows. On the other side, you have the physical market in regions where demand is immediate and where delivery is not optional. When those two diverge, you're not looking at a normal commodity curve. You're looking at a system that is pricing two different things, the price of exposure and the price of possession. Exposure can be created with a click. Possession cannot. Possession requires metal. And metal is lumpy. It moves in bars, it sits in vaults, it crosses borders, it encounters paperwork, it gets financed, it gets leased, it gets swapped. All of those steps introduce friction. That friction is why, in a stressed moment, physical can trade at a premium that looks outrageous. The premium is not just about the metal, it's about the certainty of access. Think about it like airline seats during a storm. The listed price for a ticket might be one thing, but if the flights are canceled, the real price of getting out becomes something else entirely. You can have a voucher, you can have a reservation, you can have a website quote, but what matters is the seat that actually exists on the plane that actually departs. In silver, the seat is the bar, and the departure is delivery. Now, the evidence chain. Start with a deficit. A deficit of 148.9 million ounces in a single year is not a rounding error. That is a structural imbalance. Combine it with record industrial demand, and you have the classic recipe for a market that looks fine until it doesn't. Because deficits can be papered over by above-ground stock drawdowns, recycling, and delayed purchasing, until the moment those buffers are exhausted or become too expensive. Then look at the institutional levers. A jump in margin from $22,000 to $25,000 per contract effectively says participation is now more expensive. That's a tax on leverage. Taxes on leverage reduce positions. Reduced positions can slam price, even if the physical market is unchanged. That is how you can get sudden downward candles that look like supply appeared, when in reality, leverage disappeared. Then look at the geographic premiums. A physical quote around $91 in Dubai against a much lower futures reference is a message. It says someone is willing to pay up for immediate delivery. And if that persists, it implies either transport bottlenecks, financing constraints, inventory shortages in region, or a broader distrust that paper claims will convert smoothly when needed. Here's where it gets interesting. Those premiums don't have to represent the entire market to be important. Even a narrow channel of tightness can matter because silver's marginal supply is what sets price at the edges. If only a small portion of available inventory is actually free to move, the marginal buyer competes for that small portion, and the clearing premium can jump dramatically. So what does this inevitably suggest? It suggests that the market is trying to clear two different clearinghouses at once. The derivative market wants to reduce open risk. The physical market wants to secure metal. They collide at delivery points, and when they collide, dislocations widen. Now, how does the mechanism actually work in practice? Imagine a long chain of promises. A miner sells concentrate. A refiner produces bars. Bars go into vaults. Banks and dealers create paper claims on those bars through forward contracts, swaps, and futures. End users might hedge through futures while planning physical purchases later. Investors might buy exposure without taking delivery. This is all normal, as long as the ratio of claims to available unencumbered metal doesn't get stretched too far. But when demand rises and deficits persist, the buffer shrinks. Then, when volatility hits, the system tries to protect itself by reducing leverage. That's the margin hike. It forces selling of paper exposure. The price drops. Headlines say demand is weak. Meanwhile, Physical buyers see a cheaper screen price and step in, but they discover that sourcing metal at that screen price is not straightforward. So premiums rise. At that point, arbitrage becomes harder than the textbook suggests. In theory, you buy cheaper here and sell higher there. In reality, you need metal, you need financing, you need logistics, and you need the ability to deliver into the premium market. If you can't source bars in the right form, in the right location, on the right timeline, the arbitrage is not an arbitrage. It's a wish. And the institutions know this because they live in the friction. They don't just see a spread. They see the cost of turning that spread into a real profit. They see the cost of borrowing metal, the availability of leases, the haircuts demanded by lenders, the settlement timelines, and the regulatory constraints. When those frictions rise, spreads can persist longer than outsiders believe. This is why the hidden crisis angle is so important. It's hidden because it doesn't show up as a single dramatic announcement. It shows up as a set of small technical signals that most people skip. A margin notice, a vault report, a premium in a distant hub, a persistent deficit in an industry survey. Each one alone is easy to ignore. Together, they describe a system under strain. So what happens next historically when this pattern persists? If deficits continue and industrial demand remains sticky, the market tends to move toward one of three outcomes. The conservative outcome is demand destruction by price and substitution over time. Higher prices encourage thrift, recycling, and engineering workarounds. That takes time, and it tends to happen gradually. The moderate outcome is a repricing of lease and financing conditions first, before spot price fully reflects the stress. In other words, the cost to borrow metal rises, premiums persist, and the plumbing tightens, even if the headline price looks calm. The aggressive outcome is a disorderly adjustment where physical tightness forces a rapid repricing, often following a trigger event, a delivery scramble, an inventory category shift, a sudden policy change, or a spike in physical premiums that becomes too public to ignore. Notice what I'm not doing. I'm not promising a target. I'm not saying silver will do a specific thing by a specific date. What the data suggests is conditional. If deficits persist, and if the cost of leverage keeps rising. And if physical premiums continue to show strain, then historically, the market is pushed toward higher clearing prices for deliverable metal or toward demand destruction. The system has to balance. It always balances. The only question is how. So what should you watch if you want to understand this without guessing? Watch margin announcements, not because they predict direction, but because they predict forced flows. Watch reported vault categories and changes, not just totals. Watch geographic premiums, especially when they persist for more than a headline cycle. Watch industrial demand signals, especially from solar and electronic supply chains. And watch whether investment vehicles are accumulating or bleeding metal over multiple weeks. These are the pressure gauges. It's between people who watch price and people who watch structure. Price is the output. Structure is the engine. When the engine changes, the output can surprise everyone. And this is where the information gap becomes a wealth gap. Institutions move first because they are obligated to manage risk. They can't wait for narratives. Retail moves last because retail is shown the narrative after the fact. That's not an insult. That's a design feature of the system. The system rewards those closest to the plumbing. So if you felt confused watching a paper price drop while hearing about physical shortages, you weren't missing intelligence. You were missing the map. The map is that paper and physical are not the same product under stress. One is a claim, one is an asset, and when the cost of maintaining claims rises, claims get sold even if the asset is scarce. Let's slow down and look at the vault story because that's where most viewers get misled by a single big number. London is the center of gravity for wholesale silver storage and clearing, and the vault reports can look enormous. When you see a figure like 27,818 tons sitting in London vaults at the end of a month, it feels like abundance right now. A vault is a parking garage. It tells you how many cars are parked, not how many drivers are willing to hand you their keys. Some of that metal is owned by long-term holders who are not price sensitive. Some is tied up in financing structures. And some is simply not in the right form or location for the immediate need. In the silver world, form matters. This is why the industry talks about tightness even when total stocks look large. What tightness really means is that the metal that is free, deliverable, and economically available is smaller than the headline suggests. And because industrial demand is so steady, the free float can get thin without anyone noticing, right up until a scramble reveals it. Now add in the reality that silver isn't just a monetary metal with investors dreaming about it. It's an industrial input with no substitute that matches its conductivity, reflectivity, and chemical properties at scale. Solar panels use it, electronics rely on it. The big story is energy and connectivity. When the world builds more electrified infrastructure, the quiet demand for silver doesn't ask permission from the futures market. This is also why sudden rule-driven price moves are so revealing. In a normal market, a big drop would trigger a wave of immediate supply offerings. Sellers would appear, eager to unload inventory before it falls further. But in a tight market, the opposite can happen. Sellers step back, they wait, they demand higher premiums. The screen price falls, yet the real-world acquisition price doesn't follow. That is a sign the screen is responding to financial pressure, not a flood of metal. Silver's version of a liquidity lesson is simple. A futures contract is only as good as the system's ability and willingness to convert claims into bars under stress. Most of the time, that conversion works smoothly, so the market feels seamless. But during stress, you discover how many participants never intended to touch metal at all. They intended to trade exposure. When the system forces them to reduce exposure, the price can detach from the physical reality temporarily. That temporary detachment is where the hidden crisis lives. It's hidden because it can be dismissed as technical noise. It's hidden because the vault totals look huge. It's hidden because most commentary treats silver as a simple cousin of gold instead of as a hybrid of money and manufacturing. Now, consider the institutional incentives. An exchange wants stability, a clearinghouse wants protection, a broker wants margins covered. A fund wants to avoid being the last one out. None of these players are focused on telling a clean story. They are focused on surviving the volatility. That's why you see synchronized timing without requiring coordination in the conspiratorial sense. When the same risk rules apply to everyone, everyone reacts at the same time. Meanwhile, industrial buyers don't care about timing games. They care about procurement, they hedge, they forward buy, they negotiate contracts, and when uncertainty rises, they often pull forward demand. Not because they want to speculate, but because they want continuity. That pull forward effect can make a tight market tighter. This is why physical premiums can become the most honest signal in the entire system. A premium is a real-time vote on availability. When that vote repeats day after day, it becomes hard to dismiss. At some point, one of three things usually happens. Either the reference price rises enough to coax marginal metal out, or demand gets crushed, or the system tightens terms. So access is rationed indirectly through financing and delivery conditions. However it resolves, the market has to balance. And that brings us back to the viewer's advantage. The advantage isn't predicting a number. The advantage is recognizing which phase you're in. When the phase is leverage-driven liquidation, price can be noisy and misleading. When the phase is physical tightness asserting itself, premiums and delivery conditions matter more. When policy tightens, the game becomes about who can afford to stay. So if you want a single sentence to carry with you, it's this: silver doesn't break the news, it breaks the plumbing. And you only see the break if you're looking at the joints, not the paint. This is the data ledger, where we decode what matters before its headlines. If this connected dots you hadn't lined up before, you know what to do. And remember, the question isn't whether markets adjust. The question is whether the adjustment happens before or after the crowd understands what the data was saying all along.